Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Now, one of the other considerations that we have with respect to taking advantage of being the options writer is implementing a little strategy known as the iron condor. And sometimes when we get looking, when we start Googling option strategies and looking for different, ways of participating in the market, some of the names that are presented to us become a little bit confusing. But really, the iron condor is a very simple strategy that just simply combines the two strategies that we've already talked about. So the reason why we might look to implement an iron condor is that we may expect the pair value to be range-bound for a certain period of time. All we're really looking to do is combine a call credit spread with a put credit spread. And the benefit is that we really can be only wrong on one side. And so with this in mind, take a look at, let's say, the U.S. versus the yen again, the CDD, and let's say, for example, I felt that the CDD is going to be below 80 on the third Friday of October. Well, I can sell off those 80 calls. You notice what I've done is I've actually gone a little bit further out of the money than my last example. So the further out of the money I go, the higher the probability of these options expiring worthless. Now, what this does is it just gives me a little bit more flexibility when I'm creating this iron condor. So because I'm going to collect two credits, I can be a little bit more generous with the options that I write because I'm doubling the income. So when we take a look at this, I'm going to sell the 80 strikes and I'm going to buy the 81.5. So I'm going to create a 1.5 spread between this particular call credit. At the same time, what I'm going to do is I'm going to go down, I'm going to sell the 75.5 strikes, and I'm going to buy the 74 puts. So really what has to happen between now and the third Friday of October is as long as the actual pair is trading between these particular levels, so within that yellow highlighted zone, then I will actually get to keep the entire credit. But remember, I can only be wrong on one side. So in other words, if the pair value actually moves higher and is trading between 80 and 81, well, we know for a fact that the put spread is going to expire. If the other happens and the YUK drops in value and threatens our put credit spread, well, we know for a fact that the call credit spread is going to expire. So we can only be exposed to risk on one side of the trade. Now, so the question here comes up, but it might touch 2 points. Well, we could conceivably, within the life cycle of the option of this option strategy, see an increase higher, and then we could see completely an increase lower. But remember, as the particular pair value is fluctuating, we're taking advantage of the passage of time. So in fact, the best thing that can happen for us is we see the pair value go up a little bit, go down a little bit, go sideways a little bit, so on and so forth, because every day that we move towards expiration, these two particular credit spreads are actually losing value. Now, sure, one day, one position is going to be looking like it's losing money over the next position and so on and so forth. And this is why we have to have a bigger picture outlook on and really look for that expiration date to be sort of the point at which we're concerned about, because we're going to see fluctuations in our position throughout the life cycle of the strategy. As long as we're trading below 80 in this case, or above 75.5 in the case of the puts, we really don't have anything to worry about. So in this particular case, we're looking at 4 legs, which is the term that we give to a strategy utilizing a number of different positions. And incidentally, Victoria just mentioned, it's a safe strategy because it's European. exercised, so we can't get assigned. And that's absolutely right. It really doesn't matter where the option, the underlying pair value is trading, because we're short those contracts. Nobody can, and they're European style exercise. Nobody can force us to fulfill our obligations. Unlike in the equity world, where if we were actually in the money on any one of those credit spreads, somebody could come along and say, well, you know what, I want you to deliver the shares right now. So in this case, this becomes an interesting proposition, because you truly have until expiration to decide ultimately what we're looking at. Now, there are many different reasons why one may want to get out of the position. I had a question online, would you get out, 5 to 10 days prior to expiration due to gamma, which is, of course, one of the extenuating variables in options pricing. But what I would suggest, Ray, is that it's going to cost us a fairly healthy commission to get into this trade. So rather than being oversensitive to some of these different variables, what I would look to do is, if I can just let this thing expire worthless and not incur any commissions to close it out, then that's exactly what I'm going to do. Because realistically, if all of these options expire, hey, it doesn't cost me anything to get out of the trade, and I know that I'm going to collect my maximum profits, and that's what I was looking to do in the first place. Now, Johnny's question is for the strikes to sell, based more on support and resistance or on delta. I'm looking at the underlying price chart, and I'm looking at support and resistance. I'm looking at probabilities of those options being in the money. And when I look at resistance levels and I see areas where the pair is not likely to trade above, that tells me that it's a reasonably safe place to write calls. I'll look at support levels where the pair is not likely to trade below, and it's a reasonably safe area to sell puts. Commissions are going to vary from broker to broker, guys, so I can't really comment on commissions. Ultimately, what I would suggest you do is just take a look at your individual brokers and take a look at what they charge for some of these different spreads, because it will vary from broker to broker, and the commission and its influence on your profitability will be largely due to or have a lot to do with how much you're actually placing on the trade. So if you're only buying one spread, or if you're only applying one iron condor, well, the profit potential and the credit that you're receiving is going to be offset significantly by the commissions, whereas if you're doing 10, it's not going to have quite the influence. So there's a lot of different variables that are going to influence the impact of commissions. So I just suggest you take a look at it on an individual basis. But what we're looking at here, guys, and I'll just give you more or less a generic example. We'll talk about the YUK, but without specific strikes, I'll do a one-point interval here. We're going to sell a call at 80. We're going to buy a call at 81, and that ultimately creates our bear call spread. We're then going to look to sell a put at 75, and we're going to buy a put at 74, and that creates our bull put spread. Together, that equals an iron condor. So, where previously one might be a little overwhelmed by some of the different names given to these what would be seemingly advanced strategies, what we've done here tonight is we've taken two separate strategies, a call credit spread and a put credit spread. We combined them together, and we've made the iron condor. And that's all an iron condor is. So when we take a look at this particular example, guys, what you'll notice is that my call credit spread is going to collect 36 cents, but I've got to give out 23 cents of that. My put credit spread, I'm going to collect 50 cents, but I've got to give out 31 cents of that. So the net credit is going to be 32 cents. And you could see that as long as the pair is trading above 75.15 and below 80.32, so we're talking about a 5-point range on this particular pair, we will collect our full profits. Our maximum risk exposure is the $118. Our maximum profit potential is about $32. So you can see that we're looking upwards of about a 28% return on our capital. And really what has to happen is the pair just needs to be range bound within that level for the next month. So guys, a couple of things to consider here when looking to implement these strategies. Number one, near-term expiration results in a faster option depreciation. The closer the strike prices are together, the less margin requirement. The closer the written strike pair price is to of course the current value of the underlying, the greater chance of the option expiring in the money. So what that means is that if we want to put the laws of probability in our favor more effectively, what we can do is we can give up a little bit of the profit, which is sometimes hard for us to do, I know that, but we have to understand that in the options world, profit and probability are one and the same. So if we actually put the laws of probability in our favor by choosing an option contract that has a higher probability of expiring worthless, then we can collect that consistent income on a month-over-month basis, and not have to worry ultimately about having to fulfill or having to risk a full loss on any one position. So again, the further out of the money we create these strategies, the higher the probability we are of actually collecting the full premium. So with that in mind, guys, I'll encourage everybody to take a look at the fxoptions.com site. In fact, what I might just look to do here, because we do have a couple of minutes, is I'm going to see if I can share one of my screens here, and ultimately I'll show you the site, and maybe we can take a look at it live. So just bear with me 1 second. You can see I've got a bunch of charts going here. So just bear with me 1 second while we take a look at that. So what I'm going to do is I'm just going to show you this particular site here, and we talk about the idea of looking at options that are perhaps in an environment where they are perhaps considered to be overvalued or overpriced, if you will. And so just as a quick example, I'll utilize the CDD right now, and I can click on this particular symbol, and we can take a look at some of the different variables that apply to the CDD right now. And if we talk about looking at selling options, you can see that what we're looking at here is an implied volatility of 10.85 presently. Well, you can see that the 52-week low on the CDD was 7.38, and the 52-week high was 13.31. So we've actually seen a fairly significant increase in implied volatility, about a 3% expansion in implied volatility. Now, what that means is that these options are actually trading at a little bit more of an expensive premium than what they were, in the past. And so we can take a look and we can decide whether or not it's an appropriate opportunity to trade. So you can also see, guys, as well, that we have a nice little chart that we can take a look at. We can also take a look at some of the different option contracts and prices available for this particular pair value. So there's some fantastic little tools in here that you can actually take advantage of while you're learning this particular market. Now, the other thing that I was going to just draw your attention to, guys, as well, since again we had a couple of minutes, is to take a look at the weekly outlook as well, which can be found at the FX Options site under News and Commentary. And it's a nice little short video where we're just looking at price charts. We're taking a look at the U.S. dollar and how it's trading against a basket of securities, and then we're referencing the various pairs and how we might consider taking advantage of those. So on that note, guys, I'll just return back to the presentation here. And ultimately we'll field any questions that folks might have. But I highly encourage you, if you're not already taking advantage of the of this particular these particular option contracts to certainly look a little bit more closely into that and take advantage of the opportunities that are available at this point. So with that in mind, guys, just want to again see if anybody has any questions. I'm not sure whether or not Katrina, you want to take back the presentation, and I can just remain online here and answer questions. I'll more or less leave it up to you to decide. But for the most part, guys, that is essentially it for me. And we'll encourage any questions. But if there aren't any, then we'll wrap it up here for this evening.
All right. Doesn't look like we have any additional questions at this point in time. So our thanks again to Jason for sharing the presentation today. Thanks to all of you for joining us. If you're still in the desktop application, feel free to just go. I think in the bottom corner you should have an icon so you can return back to the presentation itself. If you'd like to learn more about the ISE FX options that we discussed today, make sure to visit www.fxoptions.com. Jason did a pretty good demo, but you'll be able to play around and see the full list of available currency pairs and check out all of the other educational resources that we also have available. We do have a lot of upcoming webinars, so make sure to check back for our schedule. You can check it out on the FX Options website or at www.ise.com/webinars. Make sure to sign up. Thanks again to everyone, and we will see you back next week. Thanks, Jason.
Hey, thanks very much. Everybody have a wonderful evening. Bye for now.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX Options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.